Now to pick back up to where we were discussing previously on the monthly median wage growth for job switchers, this is getting an idea of where, as you can see, it was very advantageous to switch jobs. But there's still that delta, but it's slowing. And as that's slowing, you're starting to see the labor market kind of get a bit more into balance. Atlanta Fed wage growth tracker switcher versus stayer, you get an idea of how that's collapsing. But look at the rate of change. And that's, I think, the most important piece is the rate of change coming down, that pressure point that you're starting to see kind of mount, which is why we do see that pressure on wages. We will see that continue to ramp up, which is going to slow wage growth, even though inflation is remaining elevated, which again is going to keep things and really tighten what people are able or capable of spending. So when you look at who is still spending, it's the lower income. And the reason why is because they have to spend more to try to maintain where they are, but they're also seeing the most pressure. Now, middle income, higher income are slowing. That is where the lion's share of spending actually comes from. So that's why we do see that the lower income side really rolling over quickly. And that's where you're going to see that maximum pain as we really go through the remainder of Q4, but also well into 2024. Now, when we start looking at the hourly earnings continue to ease, you can see the trend, and it hasn't been that massive drop that we saw in 2021, but that really kind of slow grind lower as you see, inflation, especially on the sticky side, actually going back up, and then not only just going back up, but also staying elevated, and that delta is going to maximize the pain on the underlying consumer. The amount of revolving credit continues to grow, but rates of change are easing. So when you look at the rate of change, which we saw previously, it was less than expected, but the notional number is still going higher. Now, as inflation goes up, that notional number becomes a much bigger bite out of disposable income, especially as those wages pare back. So the amount of revolving credit continues to grow, but the rate of change, which again, it's difficult to continue to grow at that rate of change, especially when you look at rates and how biting those rates are and how that impacts further spending going forward. Federal Reserve credit non-revolving net change, that's the net change. But when you look at it on a month-over-month basis, you get an idea of where things are. Recent monthly decline in non-revolving credit was massive compared to history, both in nominal, the blue, and again, the percentage of change in the orange side, but not as big in the percentage of change when you look at that non-revolving piece. So again, it also shows that the end is nigh, if you will, for the consumer and how they have been spending. Convergence starting to happen as revolving consumer credit growth starts to ease and consumer sentiment improves in a choppy pattern. And it's just going to be a matter of, and this is what we've talked about on the sentiment index, it's really just going to go sideways. And eventually, as people are priced out or really just can't handle the level of debt they're taking, that's where you're going to see that pull back down and additional pressures coming through. Now, inflation and quality of labor are tied as the single most important problem, and it's unlikely to see inflation. It was getting less. Now it's back up. It's unlikely to see that change in the near term. And then labor is still a problem. So even as wages are coming down, as we showed, they're still elevated versus history. So even though you're getting into more quote unquote normal backdrop, there's still a huge problem going forward in terms of just total amounts available. Now, why were wage gains tame despite the jump in hiring? Much of the hiring was in the leisure hospitality where wages tend to be lower. The next biggest gains were education and health services, along with trade and transportation, which are middle wage sectors. So you're still seeing that slowdown on a pretty broad basis when you look at jobs and underlying activity. Small business optimism index fell to 90.8 versus 91 estimate. Outlook down sharply to negative 43, but it's not back down to the lows. But again, the small business is the largest employer within the U.S. So they're struggling to pay rent, as we showed in the previous segment. They're struggling to find labor. Inflation is still a problem. Geopolitical issues are mounting again. Supply chains right now haven't been disrupted, but again, there's a lot of uncertainty within that. Becomes its own problem and its own issues to watch. And that's why we continue to see a lot of these problems. Full-time employment has been contracting for the past 3 months, while part-time employment has been picking up slack. That's not really a good or a bad thing. It's something that is happening that we have to pay attention to, because as part-time grows, that could become a much bigger issue. Apartment supply and demand, when you look at the vacancy rates continue to move higher while units under construction have rolled over. But again, you could still see are still at the highest levels going back to 2000. But yet there's more and more availability. So at some point, we should see a much bigger drop in rents, which will help ease some of that pressure when you're looking at the housing side, starting to see some of this normalize and get a bit lower and a bit easier for people. So until we see that, again, home prices are going to stay elevated. You're still going to see that sticky inflation. We actually saw home prices reaccelerate higher, which is not something the Fed wants to see, which is why we're going to continue to see them be more aggressive when we look at the underlying activity. So that's what we have for you in the US segment. In the next segment, we're going to go abroad. We're going to have one slide on Europe and then the rest on Asia.